Will housing prices drop in 2025, or will they rise even higher? So, what's really going on? In this video, we'll analyze the forces that could pull home prices down and the factors pushing them up, so you can make informed real estate decisions. I'll start by analyzing a key chart pattern in home prices, explain what it might mean for 2025, and then move on to discuss how potential interest rate cuts could impact the market. Let's get into it. Here is a graph of housing prices over the last few years. If we look closely, we can identify a pattern known as a bearish pennant. This chart pattern typically signals a continuation of a downtrend, and here's why. It starts with a sharp decline in prices, which forms the initial flagpole. Then, we see a period of consolidation, where prices move sideways or slightly upward in a triangular shape, forming the pennant. Historically, when this pattern appears, it often leads to another leg down in prices. To help you visualize this, here's a classic bearish pennant, which predicts lower prices, and a bullish pennant, which signals the opposite, a rise in prices. Looking at this current housing price chart, I believe this bearish pennant could indicate a further drop in 2025, but it's important to consider other factors as well. Every morning, while having my first coffee, I like to check what's new in the real estate market here in the Waterloo area. Recently, I've noticed something interesting and concerning. I'm seeing a significant number of listing cancellations. In fact, about 50% of new listings number is number of canceled listings. That means every second seller is pulling their property off the market, likely because they're not satisfied with the offers or prices they're getting. This is a strong indicator that sellers are struggling to meet their price expectations, and it aligns with the idea that prices have a downward trend. When sellers are forced to cancel, it often reflects broader challenges in the market. Before we discuss how potential interest rate cuts could impact the market, let's take a quick look at housing prices in the Kitchener-Waterloo area for November 2024. In November, the average sale price for all residential properties in Waterloo Region was close to $755,000. This represents a 0.2% decrease compared to November 2023 and a 3.3% decrease compared to October 2024. Looking at this first image, we can see how prices compare to November 2023. The standout category is semi-detached homes, which saw a 4.5% increase, the biggest gain among property types. Now, on this second image, we're comparing October to November 2024. The biggest decrease is in the apartment-style condominiums, which dropped by 6.2%. This suggests condos are currently facing more pressure in the market. Now that we've seen how housing prices are trending locally, let's talk about how potential interest rate cuts could impact the market moving forward. Recently, the Bank of Canada dropped interest rates by 50 basis points, which is good news for buyers as it makes borrowing more affordable. However, this rate cut comes with a warning sign. It's a reaction to Canada's struggling economy. Canada's unemployment rate is currently at 6.8%, and as of December 6, 2024, Ontario's unemployment rate was 7.6%, higher than the long-term average of 7.37%. This is the highest rate since May 2014, excluding the COVID-19 pandemic years of 2020 and 2021. The higher unemployment rate reflects broader economic challenges, which also impact the housing market. Another critical factor to consider is the 1 million Canadian mortgages up for renewal in 2025. With rising interest rates over the past few years, many homeowners will face higher payments when they renew their mortgages. On top of this, we're already seeing rising mortgage arrears, which are a sign of financial stress for many borrowers. Delinquency is expected to continue rising. RBC has also seen its mortgage arrears continue to rise. The bank reported 0.26% of its mortgage portfolio is in arrears by 90 days or more, up from 0.24% last quarter and 0.15% a year ago. The percentage of gross impaired loans in RBC's mortgage book also rose to 0.24% from 0.21% last quarter. Given the ongoing pressures on borrowers, particularly in the context of a weak economy and rising unemployment rates, RBC expects impairments to continue rising into the next year. Besides the Bank of Canada's recent cut of 50 basis points, we cannot expect an immediate economic recovery. There's always a lag between interest rate cuts and their positive effects on the economy. To better understand when the economy might recover, Let's analyze the relationship between unemployment rates and the Bank of Canada rate. Looking at this graph, we can see these two variables are inversely correlated. When the Bank of Canada rate drops, unemployment typically rises initially before eventually stabilizing. Let me break this down with historical examples. Starting in 1995, the Bank of Canada began cutting rates to stimulate the economy. However, it took 18 months before the unemployment rate hit its peak. In 2001, a similar pattern emerged. After the Bank of Canada dropped rates, it took 12 months for unemployment to reach its maximum. In 2007, following a peak in interest rates, the Bank of Canada started cutting rates, but it took another 18 months for unemployment to spike. We will skip 2020 because the COVID-19 pandemic created a temporary anomaly. Now in 2024, we see interest rates just starting to decline, while unemployment is steadily climbing. We're currently 6 to 7 months into the rate cuts, and unemployment is on its way up. Based on this historical trend, we can estimate another 6 to 12 months before unemployment spikes. So, what does this mean for the housing market? Given the lag in economic recovery, we're unlikely to see a significant increase in home buyers anytime soon, even with the recent interest rate cuts. The underlying economic challenges, including rising unemployment and mortgage arrears, are likely to continue exerting downward pressure on housing prices. Before we dive into the next segment, let's briefly discuss the new mortgage rules that came into effect on December 15th, 2024. These rules are designed to help buyers, particularly first-time home buyers, with provisions such as longer amortization periods, which lower monthly payments, lower down payment requirements for first-time buyers, and the elimination of the stress test for those switching mortgage providers. These changes may have some positive effects on selling prices by making home ownership more accessible to buyers.
No idea.
However, I don't believe these changes will significantly shift the market in the short term, because other factors like unemployment, rising mortgage arrears, and overall economic uncertainty continue to weigh heavily on the housing market. I'll dive deeper into these mortgage rule changes and their potential impact in another YouTube episode, so be sure to subscribe to catch that detailed analysis. While these new mortgage rules aim to make home ownership more accessible, the broader market dynamics can't be ignored. Factors like supply, demand, and the overall state of the economy continue to play a pivotal role in determining housing prices. So now, let's take a closer look at how these elements interact to shape the real estate landscape in our next segment. Balancing factors, supply, demand, and the economy. When we look at supply, there are some notable trends to consider. The total inventory across the market in the Waterloo Region increased by 16.7% by the end of November, resulting in a 2.8-month supply of all property types. For those unfamiliar, the number of months of inventory represents the amount of time it would take to sell off the current inventory at the current sales rate. Let's take a closer look at this graph of home prices versus monthly supply. Blue graphic represents average home prices and red graphic month supply of homes for sale. From the graph, we can see that we're currently at a supply level similar to what we experienced in 2016. By observing the past few years, it becomes clear that there's an inverse correlation between home prices and supply. Here's how it works. When we see a peak in inventory, we typically experience a local minimum in home prices. Conversely, when we see a minimum in supply, it usually leads to a local maximum in home prices. Now, looking at current trends, we can see that supply is increasing overall. However, the situation right now reflects a seasonal local minimum in supply due to the upcoming holiday season. This temporary dip is likely to be followed by a rise in inventory early next year as the market picks up again. What does this mean for home prices? With a sufficient number of houses expected to be available in the near future, we may see continued pressure on home prices, particularly as the market adjusts to the increasing inventory levels. To wrap things up, the real estate market is influenced by a complex mix of factors, from supply and demand dynamics to interest rate changes and new mortgage rules. It's always evolving, and I'll be here to keep you updated with the latest insights. As we approach the holiday season, I want to take a moment to wish you all a Merry Christmas and a Happy New Year. Don't forget, you can download my free ebook with essential tips for selling your home. It's available through the link in the description below. Also, check out this video where I go into detail about what's inside the ebook. If you found this video helpful, please consider subscribing to my channel for more market insights and real estate tips. Thanks for watching, and I'll see you in the next one.